is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. European banks slammed after Silicon Valley Bank plunges 60% as the startup lender struggles to restore confidence in its financial health. We'll bring you the pre-market latest in just a moment. Traders dump stocks and buy bonds over concern of broader economic distress. As U.S. bank shares slumped to their lowest since 2020. We speak with the founder and chief executive of Algebris, Davide Serra. Plus, we get the payrolls report later today for February. We'll be watching for direction of the Fed's rate hiking path. Now, first thing is first. It's a big day for the markets. If you look across the board, a lot of these banks are getting slammed. By far, the biggest industry group, losing the most, 4.4% lower. Now, the German 10-year yield, I know there's generally a risk-off mood, but the question is, and we will spend probably the next hour to really try and deep dive into this, is what exactly is happening with the banks. So do we worry about a contagion risk? The big question, of course, that started yesterday is not only what happens with SVB, but Wall Street and analysts are pondering a crisis. This, of course, is because rising interest rates have left banks laden with low interest bonds that cannot be sold in a hurry without losses. Who would have to sell some of these if there was a run of the banks? And does it mean longer term that the business model of some of these banks will be put under pressure simply because they'll have to hire or they'll have to offer more to make sure that some of their clients stick to them to some of the deposits? Now, some of the questions that we have is, first of all, why Deutsche Bank is down 7.6%. Is this a modeling problem going forward? And then if you look also at the investors and what they've done over the last 5 to 6 months was actually pile into some of these stocks simply because the Fed is also rising interest rates. So the easiest way to get protection with rising interest rates is actually going to some of the banks. But of course, there's a vicious circle if then there are questions about whether they need to sell some of these bonds at a loss. Santander down 4.5%, and you can see Intesa Sanpaolo over in Italy 3.2% lower. I think we also have pre-market, some of the U.S. banks. This is critical, as our Tom Metcalf, who oversees our financial coverage, was telling us. It'll be interesting to see, first of all, about how SVB Financial is opening. Yesterday, they were down 60% pre-market. They're down 22%. But as soon as some of the American Wall Street banks stabilize, it could also give us a floor for some of the banking stocks in Europe. So Silicon Valley Bank, this lender that is little known, frankly, outside tech circles, has sparked this wave of panic. And that, of course, has dragged down banking shares around the world. It comes after SVB announced a surprise $2.25 billion share sale. Meanwhile, the bank's top executive has urged calm. Well, earlier we spoke to prominent investor Mark Suster, who warned against overreaction.
The reason I'm urging calm is I do not believe that anybody will lose money if they leave money in SVB. Why? Because in the United States, it's been since the 1980s, since there has been an insolvency in a bank in which people lost deposit monies. All throughout the global financial crisis, depositors were made whole.
Let's bring in Bloomberg's Danny Berger, who explains this beautifully and in simple terms. So, Danny, what do we know exactly went on at SVB?
Well, it's this toxic mix between a weird accounting quirk, the Fed hiking rates, and trouble in VC land. So the weird accounting quirk thing is that banks are able to hold bonds on their balance sheet and not mark to market them. In other words, when bonds fall, they don't have to show that on their balance sheet if they call them held to maturity. SVB said they had about $91 billion worth of these bonds. And look, if they're taking a loss, they're not putting it on their balance sheet. It doesn't really matter in normal times. When it matters is if you have to liquidate them for some reason and you take a big hit. Now, why might you need to liquidate them? Because there's troubles in VC land. VC companies need money back. You have withdrawals. And that's the fear at SVB and the thought behind why they had put out that release saying they needed a capital injection, that maybe there was this mismatch. So it really is all about that bond portfolio and having to sell it down.
So, Danny, explain to me, could this be the start of a much bigger problem? And actually, when do we find out if it is giving some of these European banks are really getting slammed? Again, I'm looking at Crédit Agricole, 3.7% lower, HSBC, 5.5% lower.
Well, look, there are a lot of idiosyncratic things about SVB. For one, its clientele isn't going to look like UniCredit's clientele, for example. It's a lot of VC founders, VC companies, people with a lot of money. It's not sort of everyday people depositing money at SVB. So that's one aspect. There's no diversification within their client base. The other thing is we need to know what the bonds are on the balance sheet. SVB had really long duration type assets that were especially hit hard. Now, what European balance sheets look like, I mean, there's so much regulation. It's not the same type of thing that's going to be hurt as badly if there are liquidations. There are also swaps that a lot of these banks use, so there's more protection there. But when it comes to the U.S. regional banks, perhaps there are more similarities, maybe not so many that the exact same thing would happen. But that's why you saw a lot of those regional banks get hit especially hard.
Yeah, Danny, thank you so much for the great explainer. Danny Berger there with the very latest on SVB. Now, for more, let's also bring in Ven Ram from our Bloomberg MLive team. Ven, I know you're a big thinker on some of these, things that we cover. So the drag from SVB into Europe is quite serious this morning. How is the bank so little known outside of the tech hub in the U.S. causing so much shockwaves this morning?
Morning, Francine. At the moment, what we are seeing in Europe is blind panic as opposed to informed panic. Blind panic because traders are first selling anything that is associated with risk first and then asking questions later. So it's not an informed judgment. OK, there is going to be another systemic crisis, another crisis that is going to impinge across the Atlantic, cross over the Atlantic and impinge local banks here. That's not the concern. But the thing is, this is about investor psychology rather than fundamentals. And when psychology takes over the markets, you see what we are seeing now, i.e. stocks being sold down and government bonds being bid up.
But we know that rising interest rates would hit some of the bonds. So is it only a problem if there's a potential run on the bank? Ven, can you talk to us about I really don't understand why Deutsche Bank is down 8.5% unless investors piled in too much or whether they're worried about how much, whether they have to mark this down.
I think, as I was saying, the traders are first selling down all risk assets and then asking questions later. They don't want to be caught holding they are fearful of what if the next shoe drops. And I don't think there is any evidence that this is going to morph into a systemic crisis just yet. But it's panic psychology in the markets at the moment. And therefore, investors want to be safe rather than sorry. And that is why they're seeing what we are seeing at the moment.
All right, Ven, thank you so much. Ven Ram there from our Bloomberg MLive team. So we'll have plenty more, of course, from this fallout, what it means for banks and what it means for Wall Street. Coming up later in the program, Algebris Investments founder and Chief Executive Officer Davide Serra joins us live. We'll get his thoughts on the banking system. Of course, we'll talk about the fallout from the Silicon Valley bank panic and potential risks to the wider banking sector. That interview, don't miss it, 9:30 a.m. UK time, 4:30 a.m. in New York, and this is Bloomberg.
This could be a tame example. There are many other banks out there. So it's very rational for investors to be asking, is there contagion in train right now?
I really don't believe that that's likely.
I don't think there's a greater risk to the financial sector. I do think some of the banks that tend to cater to the riskier sectors in the market, the venture capital, the cryptocurrency, those types of banks do have risk.
This is a classic bank run. And when the bank run starts, you don't want to be the last guy there wondering what happened.
If they can raise the capital, it's not an existential issue.
Top business leaders weighing in on the panic spreading across the startup world after Silicon Valley Bank plunged 60% as the lender struggles to restore confidence in its financial health. Now, markets still absorbing the impact of SVB's financial problems, with European banks selling off this morning. Now, venture capital firms are at the center, of course, of the fallout after Peter Thiel's Founders Fund advised its companies to pull money from SVB. Now, Bloomberg has also learned that a warning from venture investment firm Green Oaks led to its companies withdrawing $1 billion billion from its bank in recent months. So let's look at, of course, what this means for venture capitalists and, in general, capital access for some of the startups. So we're joined by Eileen Burbidge, a founder at Passion Capital Investments. Eileen, always great to have you on the program. So thank you so much for coming in. First of all, this was a bit of a shock to a lot of people. Do you have any exposure through some of the companies that you're invested in?
We do. You might have seen the stats, and I heard the sort of run through of a lot of analysis you've had in the last 24 hours, which is great and super comprehensive. Clearly, I think, some people are attesting to the fact that about 50% of American startups had their money with Silicon Valley Bank, and they were clearly making a large push across Europe as well. They've been operating in the UK for more than 10 years. They recently expanded in the Nordics as recently as just 3 months ago, and so making a really good push. And so there is a lot of exposure across the startup and the venture ecosystem here in Europe.
So, Eileen, what does that mean? First of all, can you give us a sense of what kind of companies are exposed, and what do you tell them right now? Do they keep their money with SVB? It's also, I imagine, very difficult if you're a smaller startup. You may not have a second bank account, so it's difficult to get your money out and put it elsewhere.
Yeah, there's been a range of reactions, and it's really interesting to see because obviously at Passion we have more than about 50 active portfolio companies. We also do banking as well for the fund and for our fund manager. And then we've also seen what co-investors and others are telling their portfolios, as well as how founders are reacting. And there's clearly one sort of set of reaction, which is let's move our money. And just, to be clear, the reason for that thought process is why wouldn't you? Or looking at a cost-benefit analysis, why would you not look to de-risk exposure? And so it just seems like very little action or investment or resource would be required to simply, diversify yourself away from this. On the other hand, there's probably just as many people saying, listen, this is overblown. The bank still has, more than $200 billion worth in assets. What happened and what triggered, its need to raise capital was, bond performance that is pretty separate from what's happening on the deposit side, as well as in terms of its AUM. And so this should all blow over. But you're getting both.
Yeah, is it too soon to make a call on that? And again, we don't want to fill anyone with panic. So I guess cool heads need to prevail in this kind of environment. How many calls have you fielded since this happened from founders that actually aren't really sure what to do?
So we have fielded calls from founders, that's true. We have also fielded queries from our limited partners or our investors in our funds to ask us about our opinion. And the earliest of that came in the beginning of this week. So I think it's the right thing, and I'm quite reassured, if I'm honest with you, that founders are asking for advice and sort of wanting to stick their heads up and see what others are doing. We have the same sentiment as you did, or as you just expressed, which is cooler heads will prevail. Think about the long-term viability and sort of indicators of this on the sector overall, on the bank. For companies that have a large number of deposits at banks, clearly there should have always been a treasury strategy in place. This is maybe a good wake-up call to put one in place if that wasn't already the case. But in terms of, early-stage startups or people with what I think Silicon Valley Bank would term as immaterial sort of deposit sizes or deposit books, we don't think this is existential, to borrow a term from somebody that you ran through in the run-through in your recap, just opening up this segment.
Yeah, and Eileen, I have to say, it's quite incredible to look some of the banks in Europe also being slammed. Deutsche Bank down 7.8%. Mohamed El-Erian, who I always follow very closely, says, look, there's a lot of chatter about a generalized U.S. banking system stressed due to some of the troubles. And he says, look, although the system as a whole is solid, it does not mean that every bank is. Does this have repercussions? We don't know how this will end, Eileen, but does this have repercussions to how startups will access capital?
So I think that it will. I think startups will consider the fact that, maybe having all of its funds, depending on how much it had raised, let's be clear, sort of an early stage startup, which might have raised $1 million, $2 million, $3 million. I don't think it's going to be existential for them or necessarily something they should invest a huge amount of time in. But certainly for your growth startups, who have raised tens, if not hundreds of millions of dollars or pounds, who might also have debt facilities, for example, through SVB or other banks, there should be a treasury function in place. They should be thinking about diversifying and in order to hedge against risk of any single exposure or point of failure. And so it is a good reminder of just general, I think, prudent fiscal and treasury policy. I think that as we've seen overnight, a lot of the U.S. banking sector actually took a lot of losses. As you've just alluded to, it's happening in Europe now. Again, just as it's a reminder to startup founders and startup investors to go back to fundamentals and prudent policy, it's the same in terms of, I think, the sector looking at all of the other banks that have probably had a pretty good run for the last few years unchecked in order to say, okay, let's just look, under the covers here.
Eileen, thank you so much. Smart and measured, as always. Eileen Burbidge, founder at Passion Capital Investments. Now, coming up, the Prime Minister, Rishi Sunak, travels to France to meet with the French President Emmanuel Macron today, the first such state visit in 5 years. So we're live in the French capital. We'll discuss what's on the agenda next. And this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Chinese lawmakers have voted unanimously to give Xi Jinping a third term as president. Xi won the vote in the National People's Congress by 2,952 to 0 against, giving him 5 more years in power and demonstrating his unrivaled grip over the ruling Communist Party. Li Qiang is expected to be named premier in tomorrow's session. Now, police say 8 people have been killed in a shooting at a Jehovah's Witness church in Hamburg. During the night, police in Germany's second biggest city say they believe that there was only one shooter, but it's unclear if they are among the dead. The US and India are to sign an agreement to boost coordination on chips and are discussing how to avoid over-subsidization. Commerce Secretary Gina Raimondo has travelled to the country as she looks to boost incentive plans for chip producers. Both countries are pouring government money into subsidies for the industry. Global News, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine.
Thank you so much, Leanne. Now, UK Prime Minister Rishi Sunak meets with his French counterpart Emmanuel Macron in Paris today. After years of post-Brexit strains, all eyes will be on whether the two leaders can patch up this relationship. Well, our UK correspondent Lizzie Burden joins us now from Paris. So, Lizzie, what does this summit actually mean symbolically?
Well, Francine, bromance is in the air here in Paris. Rishi Sunak's on his way here to the Elysee for a bilateral meeting with the French President Emmanuel Macron at 10 a.m. UK time. This is after, as you say, years of acrimony between the two countries. But already it looks like there's better chemistry between the two, even more so, well, much better so than with Boris Johnson or Liz Truss. The two, Sunak and Macron, are both ex-bankers, of course. They're both fans of skinny blue suits. And the foundations have been laid with the Windsor Framework, the new deal on Northern Ireland. They're expected to then meet with business leaders from both countries, and then we'll have a joint press conference at 2 p.m. And it's ahead, of course, later this month, a visit from King Charles, a state visit. So really this is being presented as a watershed moment in Franco-British relations. On the substance, they're going to talk about defence. Of course, they need to present a united front on Ukraine, especially when Russia will be watching. They need to heal some of the wounds left by the AUKUS deal, the US, UK, Australia deal on defence, which essentially sidelined the Franco-Australian submarine deal that had been on the table. But Sunak's also going to want to come home with a win on small boats, the flow of migrants crossing the Channel. It's a thorny issue to unpick, a difficult one to solve. Neither side is going to want it to overshadow the rest of the talks. And it's controversial because this week the UK government introduced legislation to deport almost all asylum seekers who reach Britain, regardless of their asylum status. The timing before this visit, as I say, interesting, but Eurasia Group's Mijtaba Rahman observes that perhaps it was less about putting pressure on Macron and more about distracting from how little realistically Sunak's going to be able to bring home on that issue.
Yeah, although I guess the tone is shifting, and of course that probably means something also on the clearinghouses on financial services. Thank you so much, Lizzie Burden, there, Bloomberg's UK correspondent for us at the Élysée Palace in Paris. Now, of course, we'll be covering all things UK every week on Thursdays, 9:30 in our half-an-hour special. The main story, of course, today is what's happening with SVB Financial, but also the fact that there was another abrupt shutdown at Silvergate. Now, the issue at both of these Californian lenders was an unusual fickle base of depositors. So keep that in mind. But actually, the big question is rising interest rates have left banks with these low-interest bonds that cannot be sold in a hurry without losses. So what does that mean if there's a bank deposit, a run on banks? And this is a vicious circle. Pre-open, pre-market, SVB Financial, a further 22% lower. And it's really infecting a lot of these European banks. Deutsche Bank down 7.5%, HSBC here in the UK down 5.5%. Coming up, a roundup of our main banking news with Davide Serra of Algebris. This is Bloomberg. European banks slammed after Silicon Valley Bank plunges 60% as the startup lender struggles to restore confidence in its financial health. We'll bring you the U.S. pre-market latest in just a moment. Traders dump stock and buy bonds over concerns of broader economic distress as U.S. bank shares slump to their lowest since 2020. We'll discuss that with the founder and chief executive officer of Algebris Investments, Davide Serra. Plus, we get the payrolls report later today for February. We'll be watching for direction of the Fed's rate hiking path. So good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Returning to the top story this morning, by far, a U.S. bank known for lending to startups has sparked panic across the sector. Now, worries over the financial health of Silicon Valley Bank prompted some venture capitalists to advise portfolio businesses to withdraw their money, even as the bank's top executive urged calm. Well, let's get straight to Algebris Investments founder and chief executive officer Davide Serra, who understands the banks intimately. Rising interest rates have left some of these banks, Davide, of course, with some of the low interest bonds that they cannot be sold in a hurry without losses. We're seeing a lot of the European banks slam. Deutsche Bank down more than 7%. The same for HSBC, down 5%. Is this justified?
Listen, this is just pure panic, because what has happened in these two small California Silicon-based Valley firm, one was intimately linked to the crypto world. We know what a huge fraud FTX has been, and that's basically the Silvergate demise. In the case of Silicon Valley Bank, first of all, the name says it all. It's a Silicon Valley Bank. This bank tripled its deposit in 1 year. Now, this doesn't happen to anyone in the world. And basically, they got deposits out of VC, and then this bank was lending money. So it was part of a VC bubble in Silicon Valley. Then what happened? They had to buy treasury, so they didn't make a mistake. They bought very safe assets. But the sharp rise in interest rate forced them to realize some mark-to-market losses, because eventually the same VC that deposited the money panicked. So I think it's a one-off, intimately linked to the Silicon Valley and tech bubble, and reminds everyone that you need to keep your deposit
diversified, right? And this is a point, is that if you're a small and mid-sized bank, then maybe your funding is less diversified than the others. But talk to me about the big banks. So I don't believe that analysts are getting it wrong or shareholders are getting it wrong and selling off some of these big holdings just because they don't understand the story. Is there a longer-term concern that the revenue will have to change because actually they'll have to compete higher or harder to, for example, by offering some of the higher interest payments to savers to keep them there?
Actually, the opposite. So I think today is a reminder that you should keep your deposits only in heavily safe, deposited and well-regulated large institutions. when people chase returns or services in small financial institutions, they always run a huge risk. You know, the Financial Stability Board has created a list of globally systemically important financial institutions, which is the one we focus on. So the HSBC, the Deutsche Bank, the BNP, the UBS, the Intesa, the Santander. These institutions have more capital, more regulation. There is a reason then, as a depositor, you are safer. Clearly, they're not going to pay on your deposits, you know, the hot money some startup and VC firm will, but then you can sleep at night. And so what I think is going to happen is every institution around the world is going to look at it, where am I keeping my deposits? And they're going to move them to the JP Morgan, Morgan Stanley, Bank of America of this world. And hence, if you've been, let's say, riding the crypto and tech bubble in VC and hot money, you're probably in trouble. Many fintechs will end up being in trouble. I've always said it. Fintech are great for TVs. I wouldn't keep my cash there. And many institutions are going to do the same.
Yeah, David, just a reminder, for the moment, it's alleged fraud with FTX. Otherwise, I'm going to get a call for the lawyers. But ironically, right, a lot of equity investors piled onto some of these big banks, Wall Street banks or some of these big European banks, because financial stocks are a good way also to ride out the Federal Reserve's interest rate hikes. Will that take a pause or a breather?
I think, you know, certainly, let's say, the interest rates have gone up faster than ever in history. And hence, in a way, market expectations are that this is going to come up in huge profits short term. The sharp rise in interest rates has second-round effect, and we're seeing some now in California. In Europe, I think the opposite is going to happen. So it's going to be a slow increase in net interest income revenue, and the safe and strong deposit institutions are going to make more profit vis-a-vis the smaller one. And the reason, because at the end of the day, financial institution, it's all about trust and the level of a capital that protects depositors. And hence, in a way, I think we're going to see a concentration of profit in the stronger and large institution. There is one good news here. This time, the Silicon Valley Bank didn't have fake assets. It had US Treasury, let's say the highest quality asset on the planet. And hence, there's nothing wrong on the asset side of financials, remember. And this is, to me, is the reason why today it's a good investment opportunity for long-term holders. And the reason is because European financials are now yielding 8 to 10% between dividend and share buyback. And they have 10 times the level of capital and less risk than they used to have. And hence, they provide a good, safe, long-term investments.
So, Davide, does it mean that you're buying some of the stocks of the bigger banks today? And again, someone who I, immensely respect and follow is Mohamed El-Arian, and he wrote a couple of tweets this morning saying, look, while the U.S. system as a whole is solid, it does not mean that every bank is. So would you also have concerns, and we have to remain measured, but do you also have concern for some of the smaller banks, maybe that are less diversified, and when do we find out about those?
Yeah, so let's say there's one difference. In the US, some of the smaller regionals can account basically part of their bond portfolio in a different way than the large US financial institutions do. So first of all, large US financial institution, zero risk. Secondly, they're going to get the business out of a smaller one, hence even more positive. In Europe, none of that applies, and hence in Europe, that phenomenon never happened. For a simple reason, we never had a tech bubble in Europe. Secondly, no banks grew up deposits by 3 times in 1 year. And third, no one just landed to start up basically getting deposits for VC. So that's a pure one-off phenomenon in California, does not apply to the rest of the banking system, which in effect is as safe as it's ever been. But it's not, you need to trust me, you need to trust the Fed and the central bank, the ECB, that run stress tests on all the major financial institutions. The smaller one might have some troubles.
And again, a lot of people are saying, and this is in no way any vindication of the ones that said, look, it's just almost impossible to go from interest rates at 0.5 or 1% to 4.5%, 5% without something breaking in the system. If it's not this, is there something else that you worry about? Or overall, do you think the financial system is strong enough to withstand even more interest rate hikes?
So the core of the financial system, again, the top 70 largest financial institutions in the world are super safe. And if anything, out of this turmoil, they're going to get even more deposits and becoming even safer. then clearly the excesses of high leverage, bubble valuation, whether it's VC, crypto tech, part of the real estate sector, are going to end up in trouble. This is the reason why I think the sharp rise in interest rates now deserve a pause, because we have too many uncertainty in the world, and the second round effect, it takes time. And hence, I think in the end that we're going to see central banks realizing that the second round effect are coming through, and hence it's time to pause, because you might run a risk, if anything, of breaking the weak part of the system and then not understanding, again, the round effects.
Thank you so much, Davide, as always, for, of course, your thoughtful messaging on the bank's Algebris founder and chief executive officer, Davide Serra. Now, earlier this week, we also spoke to economist Mariana Mazzucato about her new book, The Big Con. The book takes aim at the consulting industry and its role in business and government. Today, it's the consulting industry's turn to respond. Well, we're now joined by Tamsin Isaacson, the chief executive of the Management Consultancies Association. Tamsin, thank you so much for joining us. I'm sure, like me, you've read the book. I'm sure, like me, you've looked at exactly, what the way in which the government relationship with maybe some of the big four or some of the big consultancies will change on the back of that. What's your response?
Well, I think it's full of inaccuracies and disinformation, to be honest. Our industry is focused on delivering brilliant results for our clients. We work with tens of thousands of clients across the private and public sector very successfully. And the reason why we're experiencing 25% growth, the reason why we're employing 10,000 more people over the next couple of years is because of that delivery. We transform businesses, we transform government departments, we bring in specialist expertise and world-class capabilities, and it's really about short-term projects. It's not about displacing government resources, it's about short-term projects and providing real value for our clients.
I mean, is there something that would make the industry better, given the criticism that they've received also on not only revenue, but actually how they treat some of their employees?
I think as an industry, we are always striving to set the very highest standards for ourselves. So we invest hundreds of millions of pounds in terms of training and developing our staff. The members I represent are some of the best companies for apprentices, for diversity and inclusion. They are leaders in the private sector for the way they treat and the way they employ and recruit staff. So I reject that claim totally. We as professional services firms lead not only... You
can always become better. I mean, you can't say you're like, you're a leader in industry, and there have also been taking issues with some of the things that, others have claimed about the industry. But you can always improve from what you have right now. Where would you improve the industry?
So setting standards is really important, and helping clients to be better buyers of consulting is what we help them with. And that's exactly why we supported government with the consultancy playbook, which is a brilliant set of guidelines for government buyers about how to reach to the entire market, how to make sure that you're clear on the outcomes that you want to achieve before you contract consultants, that you have a clear governance process during that project, and fundamentally, at the end of a contract, you are transferring skills to the government department. You are upskilling civil servants, and you are leaving them in a better place. And that's what our members, MCA members, deliver.
Tamsin, thank you so much for joining us. Tamsin Isaacson, their Management Consultancies Association Chief Executive Officer, responding to some of the claims in this explosive new book. Now, coming up, we're joined by the former EU Chief Brexit negotiator, Michel Barnier. We'll get his thoughts on today's UK-France summit today in Paris. That exclusive interview is next, and this is Bloomberg. Now, later today, the UK Prime Minister Rishi Sunak meets with the French President Emmanuel Macron in Paris. It will be the first summit between the two nations since 2008, and it comes after the announcement of the Windsor Framework Deal on Northern Ireland trade. Well, we are delighted now to be joined by Michel Barnier, the former EU Chief Brexit negotiator, for an exclusive conversation on this. Mr. Barnier, thank you for joining us. Talk to us a little bit about what the relationship looks like now between France and the UK. It certainly looks less difficult than when you were in charge.
Good morning, Francine, from Helsinki. This summit between France and UK is a good news. After 6 years of cold mistrust or even disappointment. Remember the problem we face with the submarines crisis about Australia, and where we saw the UK, not only the UK, but also the United States acting not as allies must do normally between allies. So we are going to turn this page, and I think it's a good news. And I think it's a good news because we have so many challenges to face together, global challenge, that we have to look ahead more than looking at the past with nostalgia.
But so, Monsieur Barnier, when you look at, of course, some of the discussions that they will focus on between Prime Minister Sunak and President Macron, this will be, of course, on energy, on security, on migrants, and on Ukraine. What do you think can really be achieved?
I'm not involved in the details of this negotiation, the preparation of this summit, but I can expect that on Ukraine we will find a way to consolidate together the support to the Ukrainian people, even by sending arms. On migration, we have a very strong and very serious issue with so many deaths all along the channel. We have to tackle this issue with being firm and rigorous, but also with humanity, respecting the international law. And I think that the UK has to be careful not to be too far from the European policy. We have to tackle some other issue on economy. Perhaps, if I may, to reflect together what could be the common answer of the UK and France, UK and Europe to the new protectionism of the US, which is very serious. It put at stake many strong part of our industry or agriculture. So and if I may say, there is also 2 chapters where Boris Johnson refused to engage any kind of negotiation during the Brexit negotiation about cooperation with Africa, which is a common challenge for all of us, and also defense and security. So these 2 chapters are now for the future open, and I think it would be a good idea for France and the UK together to push in that direction.
Monsieur Barnier, when you look at the finance and actually the fact that a lot of Wall Street banks had to choose almost a European capital outside London, it does seem that a lot of investment and a lot of bankers have moved to Paris. Is there anything else that France can do to roll out the red carpet?
The government of France is always acting to stress and to support and consolidate its attractiveness. But to be frank, it's a choice of the UK to leave the EU, not our choice. London was, and in a certain sense is still, the main center for finance in Europe. But until the end of the participation of the UK to the EU, London was also the main door for international investment, financial investment in the common market, in the single market. It works as long as the door is in the building. The door now is outside of the building, so that explains why Paris, Frankfurt, or Amsterdam as the new place for the financial investment in the single market, because you have to be part and inside the single market to work with us. To respect the regulations, to respect the supervision.
Michel Barnier, thank you so much for your time. I hope next time we get to do an interview face-to-face here in London. Michel Barnier, the former EU chief Brexit negotiator. Now, coming up, how big is the contagion effect on the banks? The drag from Silicon Valley Bank fallout continues in Europe, so we'll have more when we return. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, about 2 hours into the open, and European banks and financials really getting slammed, trading deep in the red. Investors spooked by the troubles overnight from Silicon Valley Bank, despite the bank's top executive calling for calm. Now, for more on all of this, we're joined by Bloomberg finance reporter Tom Metcalf. First of all, Tom, we understand a lot more about what's going on at SVB. Are you surprised by the contagion into other big banks?
Yeah, the ripple effects, pretty surprising, really. Just saw on the screen there, like Deutsche Bank down 7%. All these massive, big institutional banks really getting slammed. Obviously, we saw it in the US and now in Europe. And I think, it's partly that sentiment, the fear, the uncertainty. Yeah. And the other thing people are wondering is, maybe in a different form, how are these banks kind of also exposed to this disconnect between how much paper you've got and what time frame that is, and these very sort of mobile depositors. Yeah.
So what are you looking for in our reporting? I know we just spoke to Davide Serra, and he says, look, perversely, a lot of the big banks are getting slammed, but they could be safer than the smaller ones that aren't as diversified in their deposits.
Yeah, absolutely. That would be my take. Like, you look at a big bank like an HSBC, they've got, millions of retail depositors. They have a very, very different business model to a Silicon Valley bank. So I think, the risk there, maybe this is what shareholders are pricing in, is just this contagion. And yeah, that's the thing we're looking at. Two elements. One, are there any other banks like Silicon Valley Bank out there? And two, just what are investors saying? What is sort of the market going to do and react? And will it calm down, or will this sort of continue as the US opens?
I mean, some of the other questions are, for example, even if you're a big bank, you need to make sure that your deposits stay with you, and so you need to offer them more interest to basically entice them. And so does that change the revenue model?
Yeah, I mean, it's basically a bit of a flip on what we've seen previously, where you saw that net interest margin increase. And, increasingly with these interest rates stabilise, and certainly not going to be many big increases going forwards. So, they do have to work a little bit harder to keep those depositors. But, I think whenever something like this happens, one of these, so-called bank runs, there's always going to be that, flight to quality, flight to trust. And, that's where I think those big banks are going to, actually benefit, because put your money with a JP Morgan Chase if you're worried about where it's going to be.
I mean, it's pretty ironic that also a lot of investors piled into these banks because as interest rates go high from the Fed, it seemed like a good place to be. But now we have to start revaluing some of the bonds that they're holding.
Yeah, no, exactly. Look, this is all dating back to that low interest rate era, where banks were really chasing yield. So the thing for folk to look out for, what were the lenders out there kind of chasing yield in stuff where you're going to have this sort of illiquidity on that side of things. But now with higher interest rates, you're going to be paying for it today, really.
Are there any other types of, I mean, in your question, very good question, I know we have reporters on this, is there anything like SVB potentially in Europe? I mean, when do we, I know we're investigating, but is this really the only other question that we need to try and answer in the next 24 hours?
Well, yeah, it's the sort of thing where you can kind of try and find out a similar, are there similar banks? And of course there are, but they'll be tech-focused, and they're probably none of them are like household names. The bank I always thought of in this sector was Silicon Valley Bank. When I was out in San Francisco, you really do hear and see it a lot more. Now back in the city of London, I think a lot of people will be like, who is this bank? What do they do? And I think that's reflective of, kind of the different economies. So for me, very West Coast focused.
Yeah, Tom, thank you so much. As always, Tom Metcalf, who oversees our UK banking coverage. Bloomberg Surveillance Early Edition continues in the next hour. Kritik Gupta in New York, and Edwards here in London. And this is Bloomberg.
This is a classic bank run. And when the bank run starts, you don't want to be the last guy there wondering what happened.
There are many other banks out there, so it's very rational for investors to be asking, is there contagion in train right now?
Now, the question is, will the Silicon Valley thing have legs? Yeah, to a point, but I don't think it's cause for contagion.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Panic in the startup world. Prominent venture capitalists are urging portfolio businesses to pull their money out of Silicon Valley Bank because of fears about its financial health. The latest US jobs report is out at 8:30 New York time. It could help determine what Fed policymakers do at their next meeting. And the summit in Paris. Emmanuel Macron and Rishi Sunak will try to end years of acrimonious relations between their countries. The meeting comes as the UK reports a better than expected economic growth. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Chrissy Gupta in New York. Matt Miller is off today. And boy, what a Friday, Chrissy. We've been asking for some time, as rates go higher and higher, what breaks? Well, I guess we know the answer to that now. Though, mercifully perhaps, I see that US futures are looking a little flatter.
Yeah, a little flatter. It's interesting, Anna, because today was going to be a pretty volatile day anyway because of the jobs report that we see stateside, or are going to see stateside in just a few hours' time. But we did not see the bank turmoil. Nevertheless, it is having a macro effect. Check out futures right now, lower by about 0.4%, potentially a little bit of a risk-off sentiment. I think that's really shown by what you're seeing in the 10-year yield. Because look, if you are expecting a hawkish jobs report, which, by the way, the consensus is, that would kind of pave the way for higher yields, not lower yields. Yet here we are seeing the 10-year yield at 3.85, really retreating even more from that 4% level, which shows you there is that global flight to quality, that global flight to safety that is showing up in the Treasury curve. So really kind of changing the game when it comes to that. Today's 10s curve, by the way, is the other one I want to watch, negative 99. Now that curve has kind of steepened just a little bit. We are still in inversion territory, but significantly less so than the 110 basis points we saw earlier this week. I want to, of course, talk about Bitcoin because that's going to be a major game changer as well. We're talking about SVP shortly throughout the show and in the coming hours as well. But Silvergate is also a major story, and that is affecting risk sentiment in terms of how much exposure you want to the cryptocurrency. A 19,000 handle on Bitcoin, down just shy of 2%. And I want to quickly talk about what happened overnight in Asia as well, because risk sentiment was pretty bad there too. Asia Pacific Index down about 2%, but a lot of the losses were concentrated in China. And you can really see that with the Hang Seng down about 3% overnight. And Japan, which has really been the outperformer in Asia in the last week or so, also not part of that this time around, down about, well, let's just call it 2% to round up there. But to me, it's all about the BOJ when it comes to Japan. They stuck with their easing policy, no major changes there. It is the last day for their governor, of course. That actually creating a little bit of weakness in dollar yen. 136.74 is where we're at.
Let's have a look at the European picture then, Chrissy, and it's really red. And this very bright red suggests markets that are down by more than 1.5%. To what extent is this reflecting yesterday's story on Wall Street, I suppose, is important to ask, because this is really read across from what we saw in the banking sector, on the KBW index, and in the major banks over in the United States yesterday. So there's some read across from the US into the banking sector here. And when you're selling banks here, are you doing that because you think there is any direct read across? Possibly not. Are you doing it just because banks have done really well based on expectations of higher interest rates and higher net interest margins? Or are you selling these banks because you're concerned, if there are uncrystallized losses on treasuries in the US, are there uncrystallized losses on other things here in Europe, maybe property? That was one of the conversations we had earlier. And given that, I picked a few companies to focus on today. This is a private equity business in Scandinavia, down by 8.8%. They invest, of course, in real estate, in some tech investments as well. And so you might expect that sector would be in focus, and it is. That sector selling off. Sofina, Kinnevik, other names in that sector also weaker. Deutsche Bank, the German banking sector seems to be suffering here. Commerzbank is weaker. Deutsche Bank down by 7.6%. HSBC down by 5.3%. So it's pretty broad-based. The banking sector is the worst performing sector here in Europe, as if the market is selling first and asking questions later about whether there really are links, real ones or sentiment-driven links between these two sectors on different sides of the Atlantic. And we are talking about a flight into safety here in Europe, so selling stocks and getting into government bonds. And as a result, we see movement in the German 10-year yield. This is the buying of the bonds and the yields coming down, which makes a change from what we've seen of late. But it's not providing a boost to stocks, which it might have done if it were for other more positive reasons, Chrissy.
An element of panic across the world, Anna, and it's interesting. You're starting to see overnight even some of the commentary say, look, are we in a place where some of these banks could be perhaps too big to fail? At least that's the sentiment from some prominent investors. We'll get to that in a second. One of them, Mark Suster, warned against overreaction following SVB's surprise $2.25 billion share sale. Take a listen.
The reason I'm urging calm is I do not believe that anybody will lose money if they leave money in SVB. Why? Because in the United States, it's been since the 1980s, since there has been an insolvency in a bank in which people lost deposit monies. All throughout the global financial crisis, depositors were made whole.
Bloomberg's Danny Berger joins us now. Danny, now Silicon Valley Bank isn't necessarily a name you hear from around the world, but if you are in the tech capital of the world in Silicon Valley, this is one you hear a lot. Walk us through what exactly happened over there.
It really is a case of when we talk about unintended consequences from higher rates, this is one of them. To line out exactly what happens, it comes from this accounting quirk from banks like SVB. They're allowed to hold bonds on their balance sheet and not mark to market them if they call them held to maturity. So SVB had a lot of these. $91 billion is what they valued them at, a lot of duration type assets. The thing, though, is they probably weren't worth $91 billion. The Fed has been hiking, so the value of those has fallen significantly. Usually that's not too big of a deal, but what happens if your clients want money back and you have to sell those bonds? You're not going to get all of that money. So we know a lot of the VC space, VC companies, VC funds themselves, they've been burning through funding. They likely turned to the bank to get more capital, and SVB had to liquidate all of its securities and then, of course, release that statement that they were looking for a capital injection. So it is this mismatch that finally came to a head.
Danny, good morning. Let's think about some of the customers then for SVB. We were just hearing from a guest about, there are deposit insurance schemes in place in the United States. And so that's worth thinking about when we think about customers in these situations. This is a bank that had a lot of VC funds as its customers. These are and the companies that these VCs invest in, of course. So what does it mean for them? What does it mean for the customers?
Right. Well, that insurance is $250,000. If you're a VC fund, it's going to be a whole heck of a lot more than that. So that is the problem. And already this problem stemmed from VCs having troubles, burning through funding, needing more capital. So if they're struggling to get their capital out of a bank, if that happens, that's going to be a problem for them. There have been some reports that some VCs haven't been able to get their capital out of SVB. We've had other reports that, yes, they have been. So there's a lot of back and forth, but it's just yet another headache. They're likely going to say, OK, maybe we don't bank with the likes of these regional banks. Maybe we need to go to the big bulge bracket from now on to make sure this doesn't happen.
Yeah, maybe they want to put that. They're going to be looking to put that money somewhere, aren't they? Danny, thank you very much. Bloomberg's Danny Berger with the latest on what happened at SVB and what impact it has on the client base. Bloomberg's Valerie Teitel joins us now for a closer look at the broader market fallout from SVB's surprise share sale. Valerie, take us through what we've seen in markets here.
Look, the European session was a bit rocky this morning, Anna. HSBC, BNP Paribas, Deutsche Bank, Barclays, all shares plummeting. I mean, look at this Deutsche Bank share price down 7%. All of this due to the rocky close that the U.S. had yesterday. The big four U.S. banks losing a net combined market value of $47 billion. But let's check on how they're trading so far in the pre-market today. Those big four, Citi, Wells Fargo, Bank of America, they're sliding. They're continuing the slide today. A lot of these shares are down over 1%. JP Morgan down over 1%. Wells Fargo and Citigroup also nearing 1%. These four yesterday, as I mentioned, the slide yesterday capped a $47 billion loss in market value. Many are raising an eyebrow to this, Anna, saying these four U.S. banks, they're very large, they're highly capitalized, highly regulated. It's very unlikely that they'll have to sell those high-quality liquid assets, those treasuries, at a loss due to a deposit flight. So, perhaps this is a dip that's going to be bought later, but the pre-market is showing a direction in the red.
Valerie, it's interesting. That's the equity perspective. And the bond perspective has some conflicting factors here. You're starting to see a flight to quality in the bond market. But then it's also competing with that narrative of 50 basis point Fed hikes. Square the two for us.
Yeah, it's just surprising the move we've seen in the two-year yield. This here in the yellow, that is when Powell made that statement on upping the pace. You can see that we have traded through that now. We're at a lower yield level now than when he mentioned that. The market has basically taken out that pricing in the two-year yield. Even what we've priced in for March, Critty, we were pricing almost 50 basis points exactly. That's pulled back a bit. It's now around 35. But the big question is, we were all very sure that a consensus print on NFP or even any slight beats on the payroll print number today would almost cement a 50 for the Fed. That narrative has gotten a bucket of cold water thrown on it today, that's for sure.
Yeah, things got a whole lot more complicated, didn't they? And this dynamic is also having an impact on the pricing of European rates as well. Valerie, thank you very much. Bloomberg's Valerie Teitel with the latest on the market fallout. Now, European banks falling here in Europe amid concerns of the SVB fallout. France is in the news earlier this week week, with City plotting a new trading floor in the capital as London struggles to keep up after Brexit. That set the stage for UK Prime Minister Rishi Sunak meeting his French counterpart Emmanuel Macron today. Joining us now from Paris is Bloomberg's UK correspondent Lizzie Burden. Lizzie, what does this summit mean symbolically?
Well, Anna, bromance is in the air. Rishi Sunak arrived at the Elysee just a few minutes ago, shook hands with Emmanuel Macron, and they both headed in for a bilateral behind me. It's really an opportunity to reset relations between the two nations after 7 years of acrimony, especially under Boris Johnson and Liz Truss. But Sunak and Macron seem to have much more in common. They're both ex-bankers, they both like skinny blue suits, and of course they've laid the foundation with the Windsor Framework, the new deal on Northern Ireland. So they're expected to talk one-on-one, and you can see that their right-hand ministers are arriving as we speak to business leaders from both nations, and then they'll have a joint press conference at 2 p.m. London time, and then later in the month, of course, King Charles is going to be coming for a state visit. So really this is being presented as an opportunity, as a watershed to reset Franco-British relations, but as you hinted, it's a tricky moment for Britain as more banks choose to uproot staff to Paris.
Lizzie, they can't help the skinny blue suits. We'll give them a little bit of slack on that. In terms of substance, though, what can we actually expect?
They're not just skinny blue suits, there are mankles on show as well. But in terms of the substance, we're expecting a lot of discussion of defence, of course, because Russia is watching closely to see if there's a united front on Ukraine, particularly in terms of how the war ends. They also have some wounds to heal after the AUKUS deal, when Australia, the UK and the US signed that defence deal that tanked the Franco-Australian submarine deal. But Sunak's also going to want to bring something home for the domestic audience on small boats, stopping the flow of migrants across the English Channel. It's a very thorny issue, hard one to solve. Neither side will want it to undermine the rest of the talks. What Macron wants are boots on the ground, funding for police on the northern beaches of France. Sunak is expected to agree to that because it's cheaper than paying for asylum seekers in British hotels. But what we don't expect Macron to agree to is to take back asylum seekers who've already landed in Britain. He's likely to say that one's for Brussels.
Lizzie Burden in Paris on, of course, Sunak and Macron watch and fashion watch, I might add. We thank you as always. We want to continue to watch the drop in SVP. Right now, we are seeing the shares drop about 35% in the pre-market among some of the movers. Remember, we're going to be watching this throughout the day, as well as the contagion effect or assumed contagion effect across the financial sector. But this is not the only mover you want to keep an eye on this morning. Some earnings stories from after the bell, perhaps not going to be in the spotlight as much as they would before. I want to start with Oracle here, one of the major players in the cloud business, trying to break in, gain more market share from Microsoft Alphabet. They're actually down almost 4.5% in the pre-market. Their cloud sales missing those expectations, not gaining that market share that they were so after. And in the same tech space, I want to hit DocuSign as well. A pandemic favorite, DOCU is our ticker, down just shy of 7%, 6.5% lower on the day. Their billings forecast missing their estimate. When we're talking about business investment, DocuSign is going to be a great kind of poster child for that, whereas investment into AI, into cybersecurity, those are doing well, perhaps not in these kind of technologies anymore, which really increases the need for them to diversify. I want to switch from tech and go over to the retail sector. Gap is catching my eye. GPS, another downside story, down 8.5%. A simple one there. Their sales are missing estimates. It's kind of something you're seeing in the retail space all across the board. If you were not able to capitalize on that higher income consumer, the wealthier consumer, then your sales are probably not going to come in as high. That's simply a function of inflation and some of the issues plaguing the retail space, Anna.
Chrissy, coming up on the programme, much more ahead on the SVB fallout. We will discuss with Sophie Lund-Yates, equity analyst at Hargreaves Lansdown. Does the extent of selling that we're seeing in European banks today, does that really make sense? What is the contagion we need to discuss? And what contagion fears do we dismiss? This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Matt Miller is off today. Now, keeping you up to date with news from around the world, here's the first word. The Bank of Japan maintained its easing stance in Governor Hiroki Kuroda's final meeting. The move hit the yen and bond yields. The BOJ's decision coming shortly after Parliament approved Kazuo Ude to succeed Kuroda next month. China's Xi Jinping has cemented his effort to consolidate power. Lawmakers unanimously voted to give Xi a third 5-year term as president. That demonstrated his unrivaled grip over the Communist Party. Xi has effectively discarded the collective leadership approach that China has used since its reform experiment began in the late 1970s. In Washington, it was the opening shot in high-stakes negotiations between Democrats and Republicans over the debt ceiling and government spending. President Biden unveiled a $6.9 trillion budget proposal that includes $5.5 billion in tax hikes over the next decade. It's certain to be rejected by the Republican-controlled House. President Biden and European Commission leader Ursula von der Leyen are trying to avoid a fight over trade. They meet today at the White House. The U.S. and Europe have clashed over the president's clean technology law. The two leaders are expected to agree to let European firms benefit from some of the battery subsidies offered only to U.S. producers. Anna, it is a very busy Friday, as we just laid out, but I got to say, I think SVP and the chaos in the banking industry is potentially taking the cake.
Yeah, absolutely. It seems to be pushing the jobs report, which of course we wait with great interest, pushing it to one side. We're seeing the spillover from SVB pop up in some really unlikely places, and I will just flag as one of those. Swedish pensions. The largest Swedish pension fund, Electa, is thought to be the fourth largest shareholder in SVP, and the fund says this is only 1% of assets. It'll have no impact on solvency, but it just goes to show where these linkages exist and what comes to the surface when these things happen. Right, coming up on the market, on the programme, we'll take a bigger picture of what this means for risk assets. Sophie Lund-Yates joins us from Hargreaves Lansdown. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Panic in the startup world. Prominent venture capitalists are urging portfolio businesses to pull their money out of Silicon Valley Bank because of fears about its financial health. The latest US jobs report is out at 8:30 New York time. It could help determine what Fed policymakers do at their next meeting. And the summit in Paris, Emmanuel Macron and Rishi Sunak will try to end years of acrimonious relations between their countries. The meeting comes as the UK reports better than expected economic growth. I'm Anna Edwards in London with Kriti Gupta in New York. Matt Miller is off today, and we're all looking for signs of cooler heads prevailing here today, Kriti, after the day that was yesterday on Wall Street. That might not be true of European equity markets just yet, but I can report that Nasdaq futures have just turned positive.
Yes, just barely. But you know what? I think it speaks to risk sentiment in general souring. Now, stick with me. I'll explain how that works. Essentially, this idea of flight to quality that you are seeing in treasuries, well, it applies to tech, too. It's the classic trade. If you are worried or if there's a crisis anywhere in the globe, you buy American and you buy American tech. And that has been a dynamic going back, I want to say, at least 10 years you've seen in the markets. Nevertheless, the S&P 500, I think from that dynamic, perhaps pairing some of the losses you saw earlier in the pre-market session, futures now down only 0.2%. They were down almost 0.6% earlier, like I said. But the 10-year yield is really what's catching my eye, because conflicting forces today in the bond market. On the one hand, you have that flight to quality, that flight to safety that I was just talking about. On the other hand, you have those inflationary pressures, simply the idea that a 50 basis point hike might be supported after the jobs report today, 385 on that note. And I think that conflicting kind of contradictory narrative is really shown in the 2s10 spread. Negative 98 on that inversion really shows you that the bid into the long end of the curve is actively competing with the sell-off on the short end. So you can really see that showing up in a little bit of steepening on the 2s and 10s. Nevertheless, Bitcoin is really where it all started, that risk sentiment affecting the cryptocurrency as well. That's one place where the losses are certainly souring, down about 2% and 19,000 handled there. But of course, the chaos on Wall Street right now and around the world really sprung by one name, Silicon Valley Bank, SVB. Shares are down about 39% in the pre-market. They were down 60% in yesterday's session, another 20% after hours, and are still continuing to drop as people really just head for for the exits with that company. A couple earnings, though, to put on your radar as well. Oracle is top among them, an 83 handle down just shy of about 5%, 4.4% to be exact. After their cloud sales missed expectations, they're trying to gain market share. They weren't able to. DocuSign as well, down 7.8% on the day. Their billings forecast also missing estimates, not reaping the benefits of that business investment you're seeing some of their peers get. And Anna, lastly, Gap shares down 8.5%. A lot of doom and gloom this side of the Atlantic, I've got to say. Also missing estimates. I guess people just aren't shopping at the Gap at every corner.
Right. Well, I'm not sure I can bring you anything other than the gloom here in Europe as well, Chrissy. But it is a little bit of yesterday's gloom, if that's any consolation. This is catching up with Wall Street, really. Substantial losses on Wall Street yesterday, filtering through into European equity markets and the banking sector, and other money managers certainly taking the brunt force of that. So this is the Stocks Europe 600, down by 1.5% today. And here are some of the banks that are leading us lower. Nearly all sectors in negative territory. Only utilities is a standout to the upside. Banks, financial services, all of those really very much in focus. Private equity names over in Scandinavia and beyond, also under pressure. But this is the banking sector here in Europe. Here's two names under pressure. Deutsche Bank, one of the biggest drops in percentage terms, and HSBC, one of the biggest weightings on the Stock 600 in terms of that downdraft today. Here's the German 10-year yield. This is, of course, the flight to quality that, Chrissy, you were talking about, but this is it expressed between asset classes, so getting out of stocks and into bonds, and as a result, we see a bit of a retreat in the yield, which, of course, falling yields would have been something that would have supported equities had we been talking about a very different driver, Chrissy.
Yeah, it's interesting. The tide is turning very quickly in the cross-asset space, but let's bring it back to that equity market story that you were just referring to, because it feels like tech isn't necessarily the focus today as it would be with that yield move. Instead, it's financials. Joining us now to break it all down, Sophie Lund-Yates, equity analyst at Hargreaves Lansden. Now, Sophie, this is interesting to me because on the one hand, higher rates, or the expectation of higher rates, should be a boon to the financial industry. Yet the idea, or the PTSD, for lack of a better term, of kind of the global financial crisis and some sort of banking meltdown seems to have everyone headed for the exit. How much of this move is an overreaction?
That is an excellent question, because to be really honest about it, I think we are actually seeing quite a large degree of overreaction. Really, the way that I would phrase this, again, I'm also wanting a better phrase, this is a little bit of a storm in a teacup. Really, the challenges that we've seen from SVB, really don't necessarily spell out, you know, a kind of this doomsday scenario for other major financials. We are seeing downgrades in the valuations of a lot of the major financials' bond portfolios. That is going to cause a bit of a bump in the road, but really we aren't seeing the markers for a full-scale financial wipeout or meltdown at this point, I would say.
OK, so maybe this is a little overdone. Good morning to you, Sophie. What about what this signals about the US economy? We've been asking what breaks, and maybe this is the way that weakness in the tech sector sort of spreads into other sectors and just reminds us of difficult times as rates go higher. Is this a sort of early warning sign on the US economy?
Yes, I think it definitely could be. I think to put some nerves into perspective, you know, the chances of a 50 basis point increase from the Fed at the next meeting has gone from 29% chance just last week. That's now well over 70%. So nerves are really very heightened, and, you know, stocks that are viewed as overvalued, largely in the tech space, really are quite vulnerable. The flip side of that, and to try and find a bit of brightness, I would say that what we are seeing is that valuations in the UK and Europe, as a direct effect of all of this, are actually looking a little bit more, or even more compelling. You know, they're continuing to trade below their long-term averages, and that does suggest the risk that's going on. But also, I'd say it's quite a compelling story that's going on in the background here, and potentially an interesting entry point.
OK, potentially a buying opportunity then when it comes to if you have a positive view on what happens for European and UK stocks. What about the banking sector, Sophie? Because clearly the banking sector has done really well in recent months with rates on the rise, net interest margins going higher, and investors expecting that to continue. Is this just makes us think twice about that dynamic, I suppose?
Yes, certainly. Obviously, banks are economic bellwethers, and particularly we know this has a huge bearing for the UK market. You know, financials are a huge weighting over here for the market as a whole. But really, I think the banking sector in aggregate is actually very resilient. When we look at those capital ratios, when we look at the balance sheets, they simply aren't in the same position that they were in the last financial crisis. So that's really compelling. At the same time, we've seen record buybacks. You know, they really are sitting in massive surplus capital positions, and that shouldn't be knocked. And also at the same time, I think something like your classic banks, really interest rates of 2 to 3% are the sweet spot, really, in terms of you're not looking at massive economic contractions at that point, but you're also able to make a bit of money on your services. And I think that while things are very tough right now, we are starting to see the cloud shift ever so slightly. When we look beyond this year to the middle of next year, end of 2024, we could see that sweet spot emerge again for the banks.
Sophie, I want to really zero in on the Federal Reserve here. After the jobs report today, a lot of expectations of some repricing, some major calls from banks expected as well about whether 50 basis points is validly on the table. If we do indeed get that 50 basis point hike on March 22nd from the FOMC, does that step up create more issues from a sentiment perspective as opposed to the actual margin of the move?
Yes, I think so. I think that's absolutely right. And I think particularly the thing that we need to be watching out for is whether or not the market is about to start pricing in a 6% as the terminal interest rate. And I think that is what is the likely outcome if we see a stronger than expected jobs report later on today. And at that point, I do think that we could see, purely from a sentiment perspective, some equities, particularly those that are more in the growth area, really come under renewed pressure. That said, very, very sharp shocks won't happen unless something exceptional comes out. By and large, markets know that there is economic contraction coming. It's whether or not that jobs data is particularly off the charts. As a bit of a marker, I would say that an uplift in equities could be seen if we see job additions come in under 200K. But that is a big ask.
Sophie, thank you very much. Thanks for joining us. Sophie Lundy-Yates of Hargreaves Lansdown with thoughts on the markets. Coming up, more on the fallout from SVB. We will speak with the founder and chairman of Target Global, a venture capital firm. How tough is it out there with rising rates for VCs and the unicorns that they back? We'll get to that conversation shortly. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with the US Secretary of Labour, Marty Walsh. That is at 9:30 a.m. New York time. This is Bloomberg.
I don't think there's a greater risk to the financial sector. I do think some of the banks that tend to cater to the riskier sectors in the market, the venture capital, the cryptocurrency, those types of banks do have risk.
Shana Cecil, President and CEO of Banrian Capital Management, speaking on the risks of contagion from the crisis sparked by Silicon Valley Bank, SVB. Panic has spread across the startup world due to worries about the financial health of SVB, a major lender to fledgling companies. Shmuel Chafets is founder and chairman of Target Global, a venture capital firm, and he joins us now. Shmuel, really good to have you with us. Tell me, in a rising interest rate environment, how tough is it right now? What is the daily experience for VCs as rates go higher, the cost of money on the rise?
Well, it's definitely not been a phenomenal year, right? 2022 was, I think the second half of 2022 was probably the quietest I've seen in the 15 years I've been doing this. But it has to be taken in perspective of 21 and 20, which were obviously phenomenal years. So I think there's still a lot of fuel in the tank for a lot of venture-backed companies, for a lot of firms. So it's definitely not a sort of 2009 kind of catastrophe. It's just sort of naturally slowing down. But
yeah,
of course,
and SVB, slowing down. And SVB clearly played an important role as a banker to VCs and startups over in California, Shmuel. What concerns you about what seems to be a really difficult period for SVB? What concerns you about what impact that will have on VCs and the businesses they support?
So first of all, it played a very important role globally. We're European investors, Israeli investors, and SVB is a big part of our business as well. I think SVB in the end is a community bank for a relatively small community of investors and of startup companies. And they're experiencing what I think everybody in this industry are, this hangover from 21, where they had a perfect storm, both sort of macro and the micro of this industry, and also this unique nature of the way startups raise money, where they get funded. They got funded with a lot of these mega rounds, money for 2, 3, 4 years in 21, and they're spending it. They don't have any earnings. So they start to spend it down, and SVB obviously got a lot of benefit from money coming in 21. And now, as companies are starting to deplete their reserves, it's just, I think money is going out the door organically. It also seems, and I'm far from being a banking expert, it also seems like they did some things that probably looked reasonable in 21, early 22 with the additional capital, and now with rising interests have become a problem, particularly a cash flow problem. So I think definitely it's something that's on everybody's minds. You have to remember the startup industry is very networked. Right. Everybody sits on boards, everybody talks to each other. And in the last week, every board I'm on has had this conversation of what do we do with our SVB money? And I think it has become almost an unreasonable decision to keep it. It's become a very difficult decision to say, well, we're going to keep it, we're going to take that much risk. Right. And it's also important to remember for a lot of startups, SVB is their only bank.
So just to confirm here, if we can, are you currently a customer at SVB?
Our portfolio companies are customers for many years. We have a great relationship with the bank. It's been a very good partner for all this, for the whole industry, right? You have to be, SVB is a great service provider in the tech industry. They've really have this niche down. They're lenders to a lot of startup companies. They're right. A real partner.
So it sounds like you're not pulling out your fund the way a lot of others are. Let me ask, what would it take for you to be spooked?
So first of all, I think we are definitely seeing companies pull out money, right? And we're definitely seeing companies take deposits out to other banks that are more stable. I think it is a very scary moment for SVB, and I think probably we'll need some intervention to get confidence levels back.
Does this incentivize you to diversify at the very least? Maybe not pull your entire funding from SVB, but at least put it elsewhere?
No, for sure. Our portfolio companies are definitely taking money and diversifying their banking relationships, and they have for the past few days, right? I think it's very clear. I think it's something that, as a fiduciary, as a board member, you have to sort of support in portfolio companies.
Mm. Yeah, and with that in mind, Shmuel, I mean, is the startup sector, has it allowed itself to become too reliant on one supplier in this space? Is that something we need to learn from?
I don't know if the startup sector has become too reliant, but I think definitely SVB is a systemic risk for the startup world. So again, because of the nature of this world, even a delay in withdrawals, not to mention the bank failing, but even a delay will cause a ripple effect through this industry. Companies will just not be able to pay salaries. So I think SVB is systemically important for our industry. That's definitely true.
Well, speaking of that importance, let's talk a little bit about liquidity here. We've heard some reports from our Bloomberg reporting has been all over this, that in some cases, folks haven't even been able to access the website or even try to withdraw their money. Have you come across any of those issues? What is SVB telling you as a customer?
So we have not, I have to say. We've been getting, again, it's across multiple portfolio companies and boards that I'm on. We've gotten good service. We've gotten very reasonable answers from the SVB people that we were working with. So I have to say that we haven't experienced any of those problems.
Where will the money go, Shmuel? It comes out of SVB. Where are people sending it?
I mean, I think people are sending it either, we're not American investors, so most of our companies have an operating bank in Europe and Israel. A lot of that money is probably going there. Some of it's going to more traditional commercial banks. I hope some of it will be able to get back to SVB as things clarify, as we see that the bank is doing the right things. I hope we can move money back and also support it.
Well, thank you.
building.
Thank you very much. Thanks for joining us. Good to get your perspective. Shmuel Chafets of Target Global. Thank you so much for joining us. Coming up on the programme, the latest US jobs report is due in just a few hours. We'll preview that next. This is Bloomberg.